Good evening, ladies and gentlemen. This is Barry Norman on behalf of Alvexo, and welcome to our webinar on stochastics. Now, tonight's class is sponsored by Alvexo, one of the world's leading Forex and CFD providers. And if you like, during class, if you go to www.alvexo.com, you can set up a demo account. There's no credit card required, and you can follow along on the charts from Alvexo. Now, they offer an incredibly great and easy to use web trader. Just recently launched, their all new web trader is user friendly. It's got tailored reporting. It's got built-in trading signals, everything you need right on their web-based trading platform. Or you can also download their advanced MetaTrader 4 for a more professional environment if you wish. You can sign up for their Alvexo Trading Academy to learn, watch, and trade. Whether you're a beginner or an advanced trader, they have classes, webinars, seminars, and a full library of books that will help you increase your ability to trade. Now, tonight's class is being recorded, and you can access a recorded version of this class in about 24 hours by going to investing.com, where you register for tonight's webinar, and look under the Education tab and then look for Webinars on Demand. And you'll see this there in about 24 hours. Now, since Alvexo is a regulated provider, and please take a minute to go to www.alvexo.com and take a look around their site. But since they are a regulated provider, I need to read you a risk warning before we get started, and then we'll move forward with our class. Trading Forex, CFDs, and spread bets on margin carries a high level of risk and may not be suitable for all investors. You may lose more than your initial deposit and could be required to deposit additional funds. Please ensure you fully understand the risks and take care to manage your exposure. So let's get started talking about stochastics. Now, stochastics is one of the world's most recognized trading indicators. It falls in the category of what we call overbought and oversold indicators. So, have you ever had an apple fall on your head while sitting under an apple tree? No, most of us haven't. But Sir Isaac Newton did, and with that small thud, the universal law of gravitation was born. What goes up must come down. It's true not only for apples, it's true for the financial markets as well. And there are several chart oscillators that try to identify when price reaches a turning point. Now, we use the word oscillator, and I'm going to explain to you what an oscillator is, and stochastics falls into an area called a bounded oscillator. And we'll define this as we go along. One of the most regularly followed trend indicator is stochastics. It measures the distance between the asset's closing price and the range of highs and lows over a specific period. As the asset closes near the high of the range, the stochastics oscillator rises. And as this asset closes nearer the low of the range, it falls. Now, proponents tend to like the Stochastics Oscillator because it's easy to remember its defined range of 0 to 100. Okay, whenever you use the calculations to come up with the value for stochastics, it will always be in between 0 and 100. Now, in this case, the only numbers we're looking at are when the oscillator moves over 80 or under 20. So therefore, it's called a bounded oscillator because it's bounded between the 0 and the 100, and an oscillator because it's oscillating or cycling up and down in this scale. Now, it was developed by George Lane in the late 1950s. So it was originally developed for the stock market. Dr. Lane was quoted as saying, if you visualize a rocket going up in the air, before it can turn down, it must slow down. So in other words, a rocket shooting up can reverse and fall right back down, but it's got to slow down when it's going to make that reversal. Now, it can come down with more momentum than it went up, but if you can see that point at which it slows down, you can recognize that that reversal is about to come. Now, these are the steps to add the stochastics oscillator to your chart. And on most charts, locate the tab and we'll find the oscillator. So let's go over to the chart and let's see how to do this. So hold on, let me pop up a chart for you. Okay. So we're looking at a standard Euro-US dollar chart in a 1 hour chart, only because this is the standard chart I use for class. Now what you do is, in the case of TradingView or Alvexa, you'd locate where their indicator section is, and you scroll down till you find stochastics. Now today, because stochastics is so popular, it's available on every computerized charting service out there. Now, I've already put it on this chart and got it set up for class. Now, stochastics is dropped on to your charts below the price chart. Now, you can see it is bound between the 100 and the 0 level. And between here, we've marked off the 80 and the 20 and the 80 range. Now, we haven't. Almost all systems will do this automatically. Now, I've set up the colors and darkened them in so they're easier for you to view. Okay. But so anything in this purple area, you could define as a waste of time. Now, there are some people that see things in this area, and you do want to know whether the price, if it's above the 80, is it moving farther up or coming down towards the 80? But the only area that counts is from this level to this level, or from this level to this level. And number one, that's why it's bounded. Number two, it's an oscillator because it's oscillating up and down between these ranges. And as you can see, there are two lines down below. These are referred to as the K and the D. And we'll explain to you in a minute what these K and the Ds are. But this is percent K and percent D. This is the red and the blue lines. Again, I've selected red and blue. You can have pink and purple, orange and green, whatever you want, as long as you know which one's the percent D and the percent K. You can set the background for whatever color and not even see it. It's completely up to you. I've just done this so you can visualize it and see it easier on the chart. But this is what stochastics looks like when we put it on our chart. So we're going to go back and talk a little bit about the formula for each one of these lines so that we can see when we use the inputs why we're using a 14 period and a 3 period and a 3 period smoothing. So we can see this is a 1433, which is a standard formula for stochastics. But let's go back to my PowerPoint and let's talk about what these numbers and what these lines are that are used to make up the stochastics. So let me pop this PowerPoint back up on your screen here. Okay, so as with most oscillators, you'll need to know the directional trend of an asset, whether it's rising or falling. Okay. You'll need to determine that the trend over a set period of time, for example, a 20 period moving average, and it may help you to look at your asset in a table. Now let's focus on one of the three variations of this indicator known as slow stochastics. So we start out with the fast moving line is shown as the percent K. And the slow moving line is the percent D. A slow stochastic smooths the percent K line using a default of 3 period simple moving average. And the percent D then reflects a moving average of the percent K. Whoa, that's a mouthful, isn't it? The percent K crossed over the percent D, giving the indication of support. as for the price portion of the chart. Now, let's break this down a little bit so it makes some sense. The stochastic oscillator is a momentum indicator comparing the closing price of a security to a range of its prices over a certain period of time. The sensitivity of the oscillator to the market movement is deducible by adjusting the time period or by taking a moving average of the results. Okay, so the general theory serving as the foundation for this indicator is the market in a market trending upward, prices will move near the high, and in a market trending downward, the prices will move near the low. In other words, above 20 or below 20 or above 80. Then transaction signals are created when the percent K crosses through the 3-period moving average, which is called the percent D. So we have two lines, percent K and percent D. Okay, so before we can get into using stochastics, we should be clear about what momentum actually is. Now, Investopedia defines momentum as the rate of acceleration of the price of a security. How fast an asset is moving. I am always a fan of going into how an indicator analyzes price, and without getting too deep into the mathematics, this is how the indicator analyzes price. The stochastic indicator analyzes a price range over a specific time period or price candles. The typical setting for stochastics are 5 or 14 periods. So we looked at a 14 period. This means that the stochastics indicator takes the absolute high and the absolute low of that period and compares it to the closing price. We will see how this works with the following two examples, and I've chosen a 5-period stochastics, which means that the stochastics only looks at the last 5 candles. Now you can use as many as you want, and the more candles you use, the more precise the period is. But the stochastic oscillator is calculated by using this formula. Percent K equals 100 of the close minus the low for the last 14 periods, divided by the high minus the low for the 14 periods. Okay. That's a lot of mathematics. C is the most recent close. L14 is the low for the 14 previous trading sessions or previous candles. H14 is the highest price traded during that same 14 period, and the percent key is the current market rate of that currency pair. And then the percent D is a 3-period moving average of the percent K. So percent D is really easy. All we're doing is taking the last 3 percent Ks, adding them together and dividing it by 3. And that gives us our second line, which, like if we're using MACD, is called our signal or our trigger line. So how do we get percent K? 100 times the most recent closing price from the last candle minus the low for the 14 previous trading sessions. Then we divide that by the high, and that's the highest price during the 14 periods. Now, we're not adding all the lows together for L14. We're just looking over the last 14 periods. What was the lowest price? So we're taking the close price minus the lowest price it hit in the last 14 periods, divided by the highest price it hit in the last 14 periods, minus that same low of those 14-day periods. Okay, so we're taking 100 and then we're multiplying that times the close minus the low for the 14 periods, dividing that all by the high for the 14 periods minus the low for the 14 periods. Okay. Now, it's not very hard to do. You could actually do it by hand in a calculator, but you'd have to do it over and over and over and over and over again. So we use our computer and drop it on. But you have to understand where the two lines come from. So we have the percent K and the percent D. So let's go back and look at these on the chart again. Okay, so on my chart, right here, I have set my red as my percent D. So my percent D is my 3-period moving average of my percent K. So percent K is the blue. I'm not so good at writing on the screen. And the red is the percent D. So this is 100 times the close, whatever this close was, minus the lowest point over the last 14 candles. 1 candle, 2 candle, 3 candle, 4 candle, 5 candle, 6, 7, 8, 9, 10, 11, 12, 13, 14. So what was the lowest period? That would be that price here. So we would subtract that price, and then we would divide that by the highest point in those 14 candles, which would be here, minus this low, and that would give us this value right here of our blue line. We would take the 3-period moving average of that, and that would give us our percent D. So we got a 14, 3, and 3. Follow me? Okay. So let's go back to my PowerPoint. So we now have the two lines on our chart. We have our range of 0 to 100. We have our line above separating the above 80s and our line below separating the below 20s. And we have our two lines. Now, the general theory serving as the foundation for this indicator is that the market, in a market trending upwards, prices will close near the high. And in a market trending downward, prices will close near the lower. Transaction signals are created when the percent K crosses through the percent D. So what we're looking for is when the blue line crosses above or below the red line, these are transaction signals. But the only time they have any value is when they're above 80 or below 20. Now, when the price moves above the 80, as I said, price in an upward trending market should be trading towards the upper values. Price in a down trading market should be trading towards the lower end of the indicator. So the premise for stochastics holds that an asset's closing price tends to trade at the high end of the day's price action. Price action is the prices at which an asset traded throughout the daily session. Now, there are many books written on technical analysis, and the term normalization to describe stochastics oscillator that have predetermined boundaries both the high and the low sides. An example of such an oscillator is the relative RSI, which also is between 0 and 100, and is set at 0 and to 20 to 80 or a 30 to 70 range. Now, the K line is the fastest and the D line is the slower of the two lines. The investor needs to watch as the D line, the percent D, and the price of the issue begin to change direction and move into either the overbought, the over 80 line, or the oversold under 20 position. The investor needs to consider selling the asset when the indicator moves above 80. Conversely, an investor needs to consider buying an issue that is below the 20 line. Now, the thing that you have to learn is that under 20 or over 80 is telling you the market is either overbought or oversold. An overbought or oversold market can remain in an overbought or oversold condition. So one of the reasons we look for the crossover in the percent D is between the percent D and the percent K is then it's giving us the transaction signal. Because just because something's reaching an overbought level doesn't mean it's going to fall. So when your stochastics is at a high value, it means that price closed near the top of the range over a certain time period or number of candles. The graphic shows that the low was at $60 and the high was at $100. And the price closed almost at the very top at 95. The stochastic shows 88%, which means that the security only closed 12% above its absolute top. A low stochastics number, conversely, a low stochastics value indicates that the momentum to the downside is strong. In the graphic, we can see that the price only closed $5 above the low of the range. The main difference between the fast and the slow stochastics is summed up in one word: sensitivity. The fast stochastics is more sensitive than the slow stochastics to changes in prices of the underlying security and will result in many transaction signals. However, to really understand this difference, you should first understand what the stochastic momentum indicator is all about. The stochastics momentum indicator is used to compare where a securities price closed relative to the price range over the period. Now, there are three versions of the stochastics oscillator. The fast stochastics oscillator is based on George Lane's original formulas percent K and percent D. Percent K is the fast version that appears rather choppy, and the percent D is the 3-day smooth, simple moving average of this percent K. In fact, Lane uses percent D to generate buy and sell signals on bullish and bearish divergence. Lane asserts that the percent D divergence is the only signal which will cause you to buy or sell. Now, because the percent D of the fast stochastics oscillator is used for signals, the slow stochastics oscillator was introduced to reflect this emphasis. The slow stochastics oscillator smooths percent K with the 3-day SMA, which is exactly what percent D is in the fast stochastics oscillator. Notice that the percent K in the slow stochastics equals percent D in the fast stochastics. Okay. Now, this gets a little bit confusing because in Forex and CFD trading, we generally only use the fast stochastics, and we're using the standard 1433 for our evaluation purposes. In a stock market, which is a relatively slower moving market, we would use the slow stochastics. As a bound oscillator, the stochastics oscillator makes it easy to identify overbought and oversold levels. The oscillator ranges from 0 to 100. No matter how fast the security advances or declines, the stochastics oscillator will always fluctuate within this range. Traditional settings use 80 and 100 threshold, as 80 as the overbought threshold and 20 as the oversold threshold. These levels can be adjusted to suit analytic needs and securities characteristics. A reading above 80 for a 20-day stochastic oscillator would indicate that the underlying security was trading near the top of its 20-day range. Readings below 420 occur when the security is trading at the low end of the range. Now, what does this all mean to you as a CFD or a short-term? We're not really day traders. When we're trading CFDs, we're usually trying to trade within a one-day period, but not classified as a day trader. In Forex trading, most of us try to close our trades within 24 hours. So the indicator or the oscillator hold on, I'm going to pull up my chart here. I don't know. Okay. Is easily adjustable, which means that because we are trading in a fast-moving market, we would want our %K to be a relatively short time period. But this is also adjusted because we're also using a shorter-term chart. So when we flip this over to a 30-minute chart, so does the stochastics change, because it's then using 14 candles. So in this case, we're using a half-hour chart. So we're using 14 candles, which is only taking us back the last 7 hours. So we're using a 1 hour chart, it's taking us back 14 candles, but 14 hours. So it does adjust relatively quickly because we're using the indicator based on the time frame of the period that we're trading in. Okay. The other way we can do that is we can also shorten the time frame for the %K, which will give you less signals but more accurate signals. But if we stick to, and I suggest all beginners, stick to the standardized formula based on what George Lane developed. But as you notice, see, we're looking at, if we switch this to a 15-minute chart, look at how stochastics changed directly here, and now we're deep in close to the 30 range, where when we were looking at a 1 hour chart, we were coming down almost to the 20 range. So we can see the price change, but we should use our stochastics to fit the time frame of the chart and the period in which we are trading. And because it will adjust that way, it works very well for CFD and for actually, and even for crypto trading. So remember, moves above 80 warn of overbought conditions that could foreshadow a decline. Notice how the oscillator can move above 80 and remain above 80. Similarly, an oscillator move below 20 and sometimes remain below 20. The indicator is both overbought and strong when it's above 80. A subsequent move below 80 is needed to signal that some sort of reversal or failure is occurred. Conversely, the oscillator is both overbought, oversold, and weak below 20. Now, another way to see this is divergence. We can see this with the price moving in one direction. So a price is coming down and is making lower lows, while the indicator is making higher lows, or the indicator is moving up while price is moving down. So divergence form when a new high or a low in price is not confirmed by the oscillator. A bullish divergence forms when the price records a lower low, but the stochastic oscillator forms a higher low. This shows less downside momentum that could foreshadow a price reversal. A bearish divergence forms when the price records a higher high, but the stochastic oscillator forms a lower high. Once the divergence takes hold, charters should look for a confirmation to signal an actual reversal. A bearish divergence can be confirmed with a support break and a stochastic break below 50. 50 is an important level to watch. The stochastics indicator moves between 0 and 100, which makes 50 the center line. Think of it as the 50-yard line in a football match. The offense has a higher chance of scoring when it crosses the 50-yard line. The defense has the edge as long as it prevents the offense from crossing the 50-yard line. So when we see divergence, we want to see whether it's above or below 50, and we always want to see in which direction the indicator is moving. So a stochastics oscillator crosses above 50, that prices are trading in the upper half of their high-low range for the given look-back period. This suggests that the cup is half full. Conversely, a cross below 50 means that prices are trading in the bottom half of their given to look back range, and this suggests that the cup is half empty. So let's go look at this in some live charts. Okay, I've got two comparisons for you. We're going to look at gold. Now we're here looking at gold US dollar for a one-day chart, and we see the stochastics has crossed over down here below the 20 range and has moved steadily upward. And it is just breaking above the 50. Okay. Now, this is on a one-day chart. We can take that same price momentum, and let's turn off the RSI here so you don't get it mixed up. And we have indecisiveness and bullish. We see it fell below but bounced, and it crossed above the 20 line. And at the same price time, we have prices moving upward on a nice uptrend line, but they're forming a retracement right here. So we're looking at this here to here. Now we're looking at a 1 week chart of gold. And then here we're looking at the same asset, same charting for a 1 day. So here we got the bullish crossover. That's in a MACD. Let's get the MACD turned off here. And let's get the RSI shut down here. And what we're looking at in the stochastics is we have indecisiveness here also. We're up in the 50 range, okay? And we see the same price. We have a doji forming here in our candlesticks. We have a price bouncing off our support levels. And we're not sure what to do, but we have our stochastics well in the middle of the range, giving us no indication to do anything, while price is moving up towards a retracement level here. So we're sitting here at the edge. So the bulls attempted a breakout at a stiff resistance, the 20-day moving average, but restrained at this restriction. RSI and stochastics bullish moment gave a signal bullish momentum down here, and then is moving upward above the 50, but nothing's giving us a buy or sell zone. Here we can see again, we have the USD Canadian dollar moving an uptrend, but look at this, our percent B was not able to break above. It's at 98.20. It just bounced off the 98.20 range and moved down. So this was giving us all the indication the market was overbought. So we're looking for the price to fall down, but price has not dipped one drop. So we're remaining in this overbought level. Okay. And we're sitting back waiting to see what's going to happen here. Okay. And this is a 2-hour chart on the Canadian dollar. So George Lane identified another form of divergence to predict tops and bottoms. A bull setup is basically an inverse of a bullish divergence. The underlying security forms a lower high, but the stochastics oscillator forms a higher high. Even though the asset could not exceed its prior high, the higher high of the stochastic oscillator shows strengthening upside momentum. The next decline is then expected to result in a tradable bottom. A bearish setup occurs when the security forms a higher low. Now remember, what's unique about stochastics is it's not using 20, a lot of these are just simple moving averages. It's using a look back period. And it's using the highs and the lows of that look back period. So if that price is trading in towards the high end of the range, it's trading towards the highest price it's traded in that range. So if the euro is at 121 right now, and the highest it was at 121.1, say 121.5, well, it's trading towards the highest end of that whole trading range in that look back period. So it's important to understand what it's trying to tell you. Okay, and what is unique about stochastics as composed to RSI or MACD. So as with any other trading concept or tool, you should not use stochastics indicator by itself. To receive meaningful signals and improve the quality of your trades, you can combine stochastics indicator with those with three other tools. Moving averages. Moving averages can be a great addition here as they act as a filter for your signals. Also trade in the direction of your moving average as long as the price is above the moving average. Now, price formation, a breakout or a reversal trade, you should look for wedges, triangles, rectangles. When price breaks such a formation with an accelerating stochastic, it can be a potential signal for a successful breakout. And then trend lines, especially stochastic divergences or stochastic reversals, can be traded nicely with trend lines. You need to find an established trend with a valid trend line and then wait for price to break it with the confirmation of your stochastics. So to recap, you might not need the stochastics indicator if you're able to read the momentum on your charts by looking at candles. But if the stochastics is a tool of your choice, it certainly does not hurt to have it on your charts. More importantly, in this class is meant to make you realize how little you might know about the tools you're using for your trading. Additionally, there's a lot of wrong knowledge being shared among traders and even widely used, such as stochastics indicators, is often misinterpreted by the majority of traders. Do not blindly believe what other people tell you. Do your own research and build your own trading knowledge. Traders will often cite when a stock or an asset moves a higher high, but the stochastics does not exceed its previous swing high, that the trend is in jeopardy. This couldn't be farthest from the truth. The slow stochastics indicators ranges from 0 to 100. So as a stock rallies or an asset rallies, how can stochastics continue to make higher highs? Unlike price, which has no boundaries, a slow stochastics is an oscillator, so it will never truly mimic a security's price. All that matters is that stochastics continues in the direction of the primary trend. Now, please approach each strategy with an open mind. So strategy one is to identify stochastics with smooth slopes. Stochastics have smooth slopes, which move from overbought to oversold, implies that the move up and move down was sharp and without much reaction, thus strengthening the odds of a counter move up. After you get a few of these under your belt, you might take my word that you realize that you need more than slow stochastics. Strategy two, follow the sloppy stochastics. Far too often, new traders will buy oversold slow stochastics readings blindly. Remember, the slow stochastics is an oscillator, and like any other oscillator, it can trend sideways for an extended period of time. Slow stochastics will give you false signals. you will see slow stochastics just sitting beneath the 20 line, and you'll say to yourself, this is going on for too long. Trust me. You say you won't, but you will. This is the downside of indicators. It will give you the impression that a price action has to change course. However, all of the seasoned traders know that the markets will do whatever it wants whenever it wants. Three, combine the slow stochastics with trend lines. As we just mentioned earlier, the slow stochastic can provide a number of false signals. The best way I have determined to overcome the flaw is to combine the slow stochastics with trend lines to ID proper entry and exit points. Now remember, trading is not that simple. Now, I do not want to leave you with the impression that you can simply buy and sell an asset when number one is hitting the trend line and number two, it's going over 20 or 80. Trading is not that simple. You can, however, utilize the slow stochastics to validate the health of a trend relative to the previous peaks to see if the asset was able to make higher highs or lower lows in the stochastics reading. This way, you can size up the recent high relative to its predecessor to determine if it's really time to sell or if the stock has room to go. Another approach is to allow the slow stochastic to cross above a certain threshold to confirm that the counter move has in fact begun. The downside of this approach, of course, is that the move is likely to have a few points behind it before you enter a trade. Or the flip side, this will prevent you from getting caught in a stock that is just flatlining. So while momentum oscillators are best suited for trading ranges, they can also be used with securities that tend the trend, providing the trend takes on a zigzag format or a properly developed trend. Pullbacks are part of uptrends that zigzag higher. Bounces are part of downtrends that zigzag lower. In this regard, the Stochastics Oscillator can be used to identify opportunities in harmony with the bigger trend. The indicator can be used to identify turns near support or resistance. Should a security trade near support with an oversold oscillator, look for a break above 20 to signal an upturn and a successful support test. Conversely, should a security trade near resistance with an overbought stochastics oscillator, look for a break below 80 to signal a downturn and a resistance failure. The settings on the Stochastics Oscillator depends on personal preferences, trading styles, and time frames. A shorter look-back period will produce a choppy oscillator with many overbought and oversold readings. A longer look-back period will provide a smoother oscillator with fewer overbought and oversold indicators. Like all technical indicators, it's important to use the Stochastics Oscillator in conjunction with other technical tools. Volume, support and resistance, and breakouts can be used to confirm or refute signals produced by the stochastics indicator. And on that note, I'm going to say goodnight. Thank you very much for joining us. And go to www.alvexo.com and watch their videos or attend their education classes for more information on how to use stochastics. Have a good night now, and thank you very much.